Capital markets are the lifeblood of modern economies. They are vibrant marketplaces where capital flows between those who have it and those who need it. Think of them as giant financial hubs. Businesses, governments, and individuals use these markets to raise money. This money, known as capital, is crucial for growth and expansion. Without capital markets, economies would stagnate. They would lack the fuel needed for innovation and progress. Capital markets play a pivotal role in facilitating economic growth. They channel funds to their most productive uses. This efficient allocation of resources is essential for a thriving economy. By connecting investors with businesses seeking capital, these markets foster innovation and job creation. Capital markets are not just about big businesses or governments, they also provide opportunities for individuals to invest and grow their wealth. Through various investment instruments, individuals can participate in the market and benefit from economic growth. However, it is essential to remember that investments come with risks. Understanding the dynamics of capital markets is crucial for anyone looking to participate in the financial world. Whether you are a seasoned investor or just starting, grasping the fundamentals of capital markets can help you make informed financial decisions. Capital markets are broadly classified into two main categories: primary markets and secondary markets. Each plays a distinct role in the overall functioning of the capital market system. The primary market is where new securities are issued for the first time. Imagine a company going public through an initial public offering, or IPO. This initial sale of shares takes place in the primary market. The company, the issuer, receives capital directly from investors. In contrast, the secondary market is where previously issued securities are traded among investors. The New York Stock Exchange, or NYSE, and NASDAQ are examples of secondary markets. Here, investors buy and sell stocks and bonds from each other, and the issuing company is not directly involved in these transactions. The secondary market provides liquidity to investors. Liquidity refers to the ease with which an asset can be bought or sold without causing a significant change in its price. This active trading on secondary markets also helps determine the market value of securities. This information is crucial for investors and companies alike. The capital market ecosystem is a complex web of interconnected players, each with its own specific role. Understanding these players and their functions is key to navigating the intricacies of capital markets. At the heart of this ecosystem are the investors. These are individuals or institutions with capital to invest. They are constantly seeking profitable opportunities in the market. Their investment decisions drive the flow of capital and influence market trends. Companies both large and small are major players in capital markets. They issue securities like stocks and bonds to raise capital for various purposes, such as funding expansion plans or developing new products. Their performance directly impacts the returns investors earn. Financial intermediaries act as bridges between investors and those seeking capital. Banks, for example, provide loans to individuals and businesses. Investment banks assist companies in issuing new securities. Mutual funds pool money from individual investors to invest in diversified portfolios. These intermediaries play a vital role in facilitating transactions, managing risk, and ensuring the smooth functioning of capital markets. They provide essential services that connect the different parts of the ecosystem. Capital markets are the engine that drives economic growth. They facilitate the flow of capital from those who have it to those who can put it to productive use. This efficient allocation of resources is crucial for innovation, job creation, and overall economic prosperity. When businesses can access capital easily, they can invest in new projects, expand their operations, and hire more workers. This, in turn, leads to economic growth and increased prosperity for society as a whole. Governments also rely on capital markets to finance infrastructure projects and other public services. However, investing in capital markets is not without risk. The value of investments can fluctuate, and investors could potentially lose money. Therefore, it is crucial for investors to understand the concepts of risk and return. Generally, higher potential returns are associated with higher risks. Investors use various strategies to manage risk, such as diversification and hedging. Diversification involves spreading investments across different asset classes to reduce the impact of any one investment's poor performance. Hedging involves using financial instruments to offset potential losses.